Thank you, Amit, Vimal, and Gitika, and good evening, everyone. My name is Monami Dasgupta, and I'm a non-resident fellow at the Household Finance Initiative at Dwara Research. For the next session, I would like to invite Tristan Caballero Montes from University of Mons to discuss his paper titled Microfinance Regulation, Investigating the Interplay Between Interest Rate Caps and Competition in the Financial Inclusion Context. The discussant for this session is Misha Sharma from Dora Research. For this session, we have 15 minutes for Tristan to present his paper, followed by feedback and comments by Misha, and then followed by 10 minutes of Q&A from the audience. Over to you, Tristan.
Thank you very much, Monami. I will share the screen with my slides. So just tell me whether you see everything, right?
Yes, it's visible.
All right, perfect. So thank you very much for this opportunity to present this research, which, by the way, the title has changed a bit, but this is the same concepts which appear. So this research, as you can see, is part of my PhD at the University of Mons in Belgium, and as a researcher at the Center for European Research in Microfinance, which is the CERMI, which is based in Belgium too. Actually, this paper and research are about quite a different topic than what we talked about just previously, because I will talk about microfinance and try to mix two different concepts. On the one hand, competition and market conditions, but also on the other hand, regulatory issues with interest rate restrictions in this specific sector. So actually, for those who are not really familiar with microfinance, just a quick recap about microfinance, which is an industry gathering organizations often called microfinance institutions, or MFIs in the literature, and which generally pursue a double mission. They provide financial services to poor, financially excluded people, mainly in developing or emerging countries. But in the meantime, they try to do so in a quite profitable or viable way, financially speaking. And although the sector has developed very rapidly and very substantially these last decades, it has also faced a lot of crises at national but also organizational levels, as well as ethical debates, especially in terms of the rates charged by these institutions. And when we look to this development, we can really see two very important trends that have shaped the sector. On the one hand, the fact that the sector commercialized very rapidly and that competition increased in the market, and also in parallel, or even sometimes can also be considered as a response to this first trend, the fact that regulation has intensified in the industry at the image of the implementation of interest rate restrictions by more and more governments in the world. And so in this context, the aims of the paper are first to understand the effect of this specific regulation implementing interest rate restrictions or caps on especially the level of poverty of the clients reached by the microfinance institutions. Because when you look at the literature on this issue, we can clearly see that there are conceptual papers, there are very interesting case studies. There are also inventories of the use of interest rate restrictions around the world, but there are not really a large econometric study that has been done so far, to the best of my knowledge. And this is the first aim of the paper. Then I also try to link the effect of this specific regulation to the market conditions in which it is applied, because once again, when you look at the literature on microfinance regulation, the idea is to try to see the outcome of a regulation, but not so much to replace it in the context, and especially in terms of market conditions and competition, while it can really have an important conditioning of the outcome. In terms of literature review, we have to say that most authors in the literature on microfinance are considering interest rate caps as quite socially counterproductive. And the rationale that is often used is to say that as these microfinance institutions are dealing with poor, financially excluded people, they need very tiny loans and, as most of you may know, a very different and costlier business model. I won't enter here into the details, but we can clearly understand that, like, providing $100,000, for instance, to one person here in Belgium or in the United States is way less costly to do than providing $100,000 in the developing countries, and that we will split between into 500 or 1,000 loans, because you will have to repeat the process, of course, of screening and other process of of money lending, but we will also have a costlier process in itself. And so it automatically leads to higher interest rates charged by these microfinance institutions. But the interest rate restrictions are often set too low for them to survive, too low for them to remain viable with this costlier business model. And in the meantime, they are often set uniformly for all financial institutions, including banks and microfinance institutions in a way. And so the result, the outcome of such regulation is often that these organizations will tend to go around the regulation by providing loans to less costly clients, typically better off clients, which will require larger loans to be financed. And which can be considered in a way as a drift away from the social objective of these organizations. And so, although they have like good intentions a priori with using this regulation, government can exacerbate financial exclusion and have a kind of adverse effect, as suggested by the literature. And so I highlight this first hypothesis that MFIs facing interest rate restrictions or caps will provide larger loans on average. Regarding competition, on the contrary, we have quite ambiguous outcomes in the literature of microfinance. On the one hand, there are some authors who argue that competition generates some detrimental effects. An example is that some argue that it deteriorates when it increases the ability of the microfinance organizations to cross-subsidize their loan. Cross-subsidization means that typically these organizations are going to finance very poor clients, let's say, finance these clients with very small loans, which will be very costly. But in the meantime, try to compensate this very costly activity with the provision of loans to better off clients, which will be larger and which will be less costly. However, in any profitable market, actually new entrants will come in the market and will, let's say, reduce the basket of profitable or viable or less costly clients that are available. Some authors also argue that competition can exacerbate risky behaviors, just like the refinancing, the unreasonable refinancing policies of some organizations. Just like the fact of providing larger and larger loans to clients who are not really in line with these larger loans in terms of repayment capacities. I won't mention everything, but we can clearly here understand that actually competition can have this amplification effect regarding the detrimental effect of interest rate restrictions that I mentioned earlier on the loan size, the size of the loan provided. On the other hand, however, there are other authors who mention, for instance, because competition, especially from purely commercial actors, can push the organization to focus on niche markets, especially poorer clients and poorer segments. This can also attenuate, in a way, the outcome, the detrimental outcome of an interest rate restriction. And so I highlighted both hypotheses. And I will test in this paper both hypotheses in two steps. First, trying to analyze the effect of interest rate restrictions in terms of financial exclusion, but then trying to see whether there is an interaction of competition with this relationship. I use this model with as a dependent variable the average loan size of microfinance institutions, which I divide by the GDP per capita in order to have comparable, let's say, data across countries. I then use a first variable of interest, which is a binary indicating whether an organization is facing an interest rate restriction or not. And also an interaction variable combining this rate cap variable with a variable measuring the competition. I will come to this in a second. But I also use very common firm level and country level controls that I won't detail today, but I can come back on this, of course, in the discussion. And finally, I use fixed effect regressions after doing a Hostman test. Regarding then the measurement of competition, I use several approach. The main approach that I present in the paper is the use of the Erfindal-Hirschman index, which is kind of a market level approach, meaning that here the idea is to look at the market structure and the market shares, especially in order to see what is the competition in the market. However, I complement this with two robustness checks with two indicators. The first one, which is quite similar, the number of organizations in the market, but another one which is based on a more organizational approach, because it looks at the behavior of the firms, the performance of the firms, and which is the learner index. So I won't detail how I get to the learner index because we have to derive the marginal cost to replace it in the computation of the index from the computation of the estimation, sorry, of translog cost function, but we can come back to this in discussion, of course. In terms of data, I actually consolidated a database, a data set out of three main sources regarding first the regulation and interest rate restriction variable. I actually used the global microscope on financial exclusion and also some desk research and direct field contacts with central banks, with some professional networks and so on. Then I use the Microfinance Information Exchange, which is a very common data bank in the microfinance literature, especially for the data on microfinance level. But then I also use the World Bank's open data for some general economic variables. And at the end of the day, I have more than 2,500 observations over 4 years. So I won't detail, as I said, the various common countries and firm level controls that I add, but I can come back to this in the discussion, of course. So here you can see the results of the regressions that I ran. I will zoom on this part, which is the interesting part of the results, but you can see here on this first slide that actually I worked quite incrementally, adding step by step the control variables, but also the competition variables, in order to just make sure that the relationships that I observed were not just the combination of random variables, but are strongly observed relationships. So in terms of results, the first interesting result that we can highlight is certainly the positive and highly significant coefficient of rate cap. This means that everything being equal, MFIs which face an interest rate restriction will tend to provide larger loans on average. And this can confirm in a way what is suggested by the literature, and which is that actually a cap is kind of generating an adverse effect of exacerbating the financial exclusion of the poorest, which is materialized or manifested by the increase or the provision of larger loans by the operators.
Tristan, you have about 2.5 minutes left.
Yeah, perfect. Thank you very much, Monami. And the second result that we can highlight is this positive and significant result for the interaction variable, which also in this case allows to confirm the second hypothesis, which is saying that actually competition would amplify this detrimental effect that I have just mentioned. And just from a general perspective, we can really understand this in the fact that just that competition will add to the burden of these microfinance organizations, which are already facing an interest rate restrictions that is affecting their sustainability. So you can see on the figure 3 here that actually this effect of interaction is actually observable or confirmed for the whole spectrum of the competition variable, which means that this is not just a random average effect that we would point with the regression, but which is well observed for different market structures that are present in the data. And finally, as I said, I did some robustness checks, both on the independent variables, as I mentioned for the competition variables, but also on the dependent variable by adjusting with the GNI or instead of the GDP per capita, but also without any adjustment. And so the results are similar. We also did a kind of endogeneity test to make sure there is no reverse causality and endogeneity in the data, which is the Davidson-McKinnon test. So to conclude rapidly on this paper and research, I think when we look at the industry and its evolution in these last decades, we can clearly see that regulation, market structures have changed a lot. We see that institutions have commercialized a lot, that competition has increased dramatically, even to saturation in some countries. There have been some crises, and I know that most of you know the one in India, if you are familiar with microfinance. And so asking questions about what kind of industry do we want, what kind of industry is best for the performance and behavior of the institutions are important. So the paper aimed at trying to understand the effects of a specific regulation, implementing interest rate restrictions, and try to replace it in the market condition context that it is applied in. And the contribution of the paper are to first confirm the intuition or what was suggested by the literature with a large and econometric study, but also to go one step further and see that actually competition in this case is very important to consider for deciding of the implementation of this kind of restriction and its outcome in a kind of sensitive industry, just like microfinance. So thank you very much for your attention. I hope I was not too long. And of course, I'm welcoming any question and comments that you would have. Thank you very much.
Thank you, Tristan. You were on time. I would now invite Mishat for her feedback and comments.
Yeah, thanks, Monami. Let me just quickly share my screen. By the way, Monami, am I audible?
Yes, Misha.
Okay, great. And the screen is visible, right? The PPT. Okay. Thank you, Tristan, for the excellent presentation and in fact for the excellent paper. You know, we at Dwara Research, in fact, quite of us read your paper and found it really fascinating. So we have, you know, a couple of comments to share with you. So we'll quickly go over that. Let me just check the time because we're very pressed for time. So, okay, I'll try to wrap up in 10 minutes. So we'll first go through some overall comments, and then I'd like to talk a little bit about the arguments against and for interest rates. I also had a couple of comments on methodology, which I'd love to get your response on, and then maybe some general thoughts on the interest rate caps in the Indian microfinance sector. So I think I'll quickly brush through this slide in terms of the overall research framework itself. Yeah. So in terms of the overall research framework itself, you try to examine how interest rate caps affect financial inclusion or the depth of outreach of MFIs, and you use average loan size as a proxy for financial inclusion, wherein the smaller the loan, the poorer the clients, and larger loans would be a sign of financial inclusion of the poorest. How competition alters the relationship between interest rates and average loan size is the second kind of nuance that you examine in your paper. You set out two hypotheses, both really relevant and fascinating. One, which is that MFIs facing interest rate caps provide larger loans on average and therefore a sign of financial exclusion. And second, being that competition has an effect on this relationship between interest rates and average loan size. So that was just a quick overview for the audience. But really, Tristan, in terms of the overall comments, I think we were really fascinated by the fact that you were able to do empirical analysis to study an outcome of regulation. Because as you rightly point out in the paper, it is indeed very rare. Most of the analysis that we see on regulatory aspects is either a commentary or a case study, or if it's a quantitative analysis, it's just restricted to one country. So the fact that you were able to do an empirical analysis, and that to a cross-country analysis, was really amazing. Provides, just makes the methodology very strong, as well as, the validity and the implications of the study are wide. So I think that was really appreciated. The second point being that the interaction itself between competition and regulation that you test is an added nuance. Either obviously we understand that it's not binary this or that. Regulation and competition go hand in hand, and what is the dual effect of the two on interest rates is something that you discuss and flesh out in the paper, and that was really nicely done. And finally, as you've also pointed out in your presentation, the regression model we felt was very well thought out, because obviously it not just includes the 2-3 variables that you're most interested in studying, but also the MFI level control variables and the country level control variables, as well as you've normalized it, you've normalized the value. So definitely the regression was also very well thought. So those are my overall comments on the paper. Tristan, like I said, really enjoyed the paper. I wanted to, deep dive into the topic itself that you have examined. And I just wanted to make a couple of comments on the argument itself against and for interest rate caps, because this is really at the heart of your paper, right? So like you rightly find out, interest rate caps are leading to financial inclusion by your definition, which is an average, which is that the average loan sizes are going up. And therefore, one obvious policy implication that could possibly come out of your paper is that the caps on interest rates should be reconsidered. You also make the case that, having said that, one size fits all approach to imposing interest rate caps are not appropriate given the diversity of clients of MFIs the clients MFIs serve. So those are the 2 points that obviously you make in the paper. In terms of thinking a little bit more deeper about what are some of the other arguments that I can, pose against interest rate caps, I think one thing that possibly you might want to add in the paper is to actually compare the interest rate of MFIs with informal sources of finance, because really somewhere in the paper you mentioned that it can be said that interest rates of MFIs are on an average excessive to formal traditional financial service providers. But I think that if you compare it with informal sources of finance, which is somewhere between 30 to 50%, if we go to extreme cases, then I think your case about why we can do away with interest rate caps could come even more stronger, because that's really the issue in India as well as other developing countries. Another point that I think might be worth highlighting in the paper is if you itself compare this whole regulation of ceilings on interest caps in well-developed markets such as France and Germany. And this is something that we wrote about at Dwara way back in 2011, which is that the absolute the absolute exclusion of low income population has created conditions for illegal lending. So if it happens in countries like France, Germany, and other European countries, then I think we should consider what the effect will be in a developing context. So in the Indian context, I think you can make a stronger case and parallel it with the informal money lenders. And finally, another case I think that can be made against interest rate cap is the lending to limit behavior, right? So if I can just give you an example, roughly the interest rate for the microfinance Indian sector is between say 24 to 26%, right? So if the regulator says that, hey, this is your interest rate cap, then even for a microfinance service provider who is able to reduce its operation costs and the cost of funding, and they will be inclined to charge 26% itself, right? So that behavior of lending to the limit at which the regulator has set the cap could be one more argument why we should do away with interest rate cap. So I just wanted to put those points in front of you, because I think these are some of the other points you can add in your paper. Obviously, I'd love to hear your thoughts. But I also wanted to, just play the role of a devil's advocate and really think hard about, is it really all that black and white? What is the argument for interest rate caps? Because one thing that stood out to me in the paper is that clearly a lot of countries in the world think that interest rate cap is needed indeed. And from your data, I imagine that close to 50% of countries actually do impose an interest rate cap. So that really led me to think, what is the case for an interest rate cap? So if you just put it in simple words, cap on interest rate is a consumer protection tool, and to that end is achieving its purpose of controlling for usurious rates. So if there is a cap, obviously no formal financial service provider can go beyond that. Um, maybe another argument for interest rates could also be that removing caps could lead to really high costs of debt. Some MFIs might be inclined to charge really high rates, and that could lead to another type of exclusion, which is exclusion by unaffordability of credit among low-income borrowers. If the interest rate cap is really high, a low-income borrower might not be able to afford that, and therefore could lead to another type of exclusion. Finally, if there is no interest rate cap, as your data suggests that quite a few countries do not have an interest rate cap, then I think we can assume that the invisible hand of the market would determine the interest rate, right? However, we have not seen a lot of literature around MFIs conducting their own well formulated economic assessment of their risk and pricing of loans. So that we have not seen a lot of literature around. So I'd love to hear your thoughts on whether that literature exists, because then maybe there's a case that, okay, the invisible hand of the market is able to determine a fair interest rate. Another, on that point itself, a nuance that you can add in your paper is that if you can, from your data set, discuss the average interest rates over time for the two groups, countries with caps and countries without caps, then it can add more nuance to your discussion about the need for interest rate caps or the need to do away with caps. So if we see that countries without caps have been able to reduce their interest rates over time, or have been able to maintain it at levels comparable to traditional service providers, then a stronger case could be made about the need to remove interest rate cap, right? However, if we are seeing that no, countries without caps have not seen a reduction over time, and in fact has gone up, then I think we might want to question what is it that the analysis is saying and what is it that's happening on the ground. So I think a comparison between average interest rates of the two groups, countries with cap and without cap, could be nice, and I'd love to hear your thoughts on that.
Misha, 10 minutes
yes?
up.
10 minutes up. Okay, fine. So I'll just wrap up in 2 more minutes then.
Sure.
I think what the paper will benefit with is a balanced approach to the pros and cons of interest rate caps that could be discussed both at the beginning as well as the end of the paper, considering that you have strong results coming out of it. Two very quick points on the methodology. One, there are other factors that could affect loan size as well, other regulatory factors such as lending caps or indebtedness limit. I think that could also have an impact on the average loan size. So maybe you can consider that. And in terms of the regression model itself, there's an explanatory variable called ratio of donated equity to total liabilities that you use. I think it would be interesting if you can do a subsegment analysis by dividing the data into countries where the ratio to donated equity is high versus where it's low, and see if you're getting different results. So yeah, I'll stop there. Thank you, Monami, and thank you, Tristan.
Thanks, Misha. Over to you, Tristan, and everybody else for any Q&A. We have some questions in the chat box also, but if anybody would like to ask, you can unmute yourself and ask a question right away.
So shall I answer now, or
Yes, please. You can.
All right. Thank you. Thank you very much. So thank you very much, Misha, for this very comprehensive and very interesting discussion. I'm very happy because you made very positive and constructive comments. And I'm very happy to, if you agree, to have your slides afterwards, because I think I won't be able to answer everything and to see all the comments in details right now. But basically, I think you're right. Definitely, I will have to add some additional arguments that you mentioned in the beginning, just like very quickly, when you speak about the comparison between formal and informal interest rates, I think it would definitely add to the strength of the argumentation, just like also with the fact that in any case, when you put the cap as a government, the companies are going to just go to the limits of the caps, even in case they were not obliged, and they would be able to go lower. And so I think these are very interesting comments that I can add right away in the paper. So thank you very much for that. Then you ask quick questions about actually what does the literature says about when there is no cap, are interest rates reduced or decreasing in the market because of competition? So you mentioned the invisible hand of the market. Actually, I mentioned in the paper a very interesting and recent article written by Alazam and Parmenter, who are showing that over the years, over time, in this microfinance industry, the rates have decreased, and they achieve with several indicators and analysis to at least to show that at least partly competition has had a real impact on these interest rates in the market. So they don't really speak about the differences in terms of whether there is an interest rate cap or not. So which is also something that my paper can bring to the literature. But they at least they show this point that yes, competition can have a contribution in this sense. However, there are also other papers a bit less recent. I'm thinking about David Porteus from the CGAP, who wrote a paper on this, and who mentioned that actually we can also say that competition has an outcome which depends on the country, depends on the context also. So this is also, some countries will face a rejection of their interest rate with competition, but there are also other contexts in which competition does not really manifest in terms of price reduction, but more in terms of diversification of the products and services, for instance, and other mechanisms. So I think you're right that this is also something that could be nuanced a bit on this point, and that maybe I should do more in the paper. I think also that what you propose is very interesting in terms of trying to understand what is the differences between the countries which have an interest rate cap and those where there is none. Sorry. In terms of interest rates, are there higher or lower? I did this actually. I don't mention it in the presentation, but I wrote it in the paper. That the size of the loans are already different. So I showed the means for this variable in the two groups. But definitely, I think it could be interesting, and this is also to do it with the rates. And this is also a remark I had in another presentation. So thank you very much for that. And finally, on the method, so I'm not sure I will answer in a comprehensive way because I think we may not have so much time. But actually, yes, in terms of, there are of course maybe other factors that will influence the situation. You mentioned, I think you mentioned lending caps. So I guess you mean caps on the size of the loan themselves.
Yeah.
Right. So of course, so of course it can have an influence. I think it can also be difficult to have the information for all the countries, because I did the work actually for the interest rate caps for many countries, but it is a very fastidious work because there is no centralized place where you can find this information. Actually, I mentioned the global microscope, but even the source is limited in terms of number of countries, and I had to go further in my desk research. But yes, of course, maybe this is a way I could also nuance the paper. And then it rejoins a bit what you said on the two groups and the influence of whether or not there is an interest rate cap, and whether interest rates are lower or greater or higher. The fact that I can also do an analysis with subsamples, I think it's definitely also a good idea. So thank you very much for that. Monami, I don't know whether
we're running out of time, Tristan, so you might want to take questions from the audience.
Yes. Yeah, we have a few questions from Renuka, Bindu, Josh, as well as Susan. Because we have around 4.5 minutes left, Susan and Bindu, would you like to unmute yourself and ask the question?
Sure. Hi, this is Bindu. Thanks, Tristan, for that very interesting presentation. I just wanted to understand how exactly you are able to attribute the loan size changes to the interest rate cap, given that there are many other things that go on. And this is, in fact, one of the biggest, when you look at complaint databases, the biggest complaints that MFI customers have is my loan size is too small. So how do you make that attribution?
Yeah, so thank you very much for your question. Actually, I think it joins a bit also what Misha has said at the end with her presentation. So I try to use multiple control variables to make sure that some of the main influences are captured by the model. So I went quickly on that in the presentation, but in the paper I explain what variables are used and why. They are both microfinance institutions level variables, but also country level variables. So I control for inflation, for the type of markets, type of industry in the countries considered, the economic growth, and so on at the country level. But at the MFI level, I also use variables on the performance of the institutions, just like the portfolio quality and so on, but also on the types of clients that are reached by the organization. So are there more or less women? Also some variables that are related to the type of institution. So are they financed by more or less by donations? These kind of things. So I hope it answers to your question.
Yeah, thank you. And I look forward to reading the paper in more detail.
Thank you very much.
Renuka, can you ask a question?
Sure. Thanks, Monami. I have two questions. One is, have you looked at whether caps change the nature of the MFIs as well? So, for example, many of the smaller firms drop out, and the number of firms in the market actually changes because firms now, only those that are able to get cheaper source of funding can survive at these caps. And secondly, do you know, I mean, do you sort of look into how these caps are set? Because in some countries, there might be an absolute cap, whereas in some countries, it's sort of the difference between the cost of funds and the profits or revenue. And would that make a difference in how we think of interest rate caps?
Thank you very much, Renuka. So these are two very interesting questions. In terms of, so for the first one, I don't really look directly on what does it change for the firm. I mean, on their own. So I provide an explanation. I tend to provide an explanation of why the size of the loan can increase. And so I mentioned in the presentation and in the paper mostly that there is this cross-subsidization effect, which is not really, which is less possible, I think, with the cap. But also what I try to maybe to launch as a way to explain the results is that maybe potentially the smallest MFIs also. So we know that when competition increases, it is I mean, the institutions which have more ability to have economies of scale and to be more efficient are the ones which are going to be more competitive on the market, of course. However, the smallest MFIs are often not so much able to have these economies of scale and to remain competitive in the market when competition increases, just like as in many markets other than microfinance. And so I think that in this way, by making that this is more difficult for the very small institutions, this can also push them out of the market if they are not able to be sustainable anymore or to be competitive with the other on the market. And by doing so, actually, it can also have an effect on the loan size that is provided in general on the market, because I think these very small institutions, which are maybe less efficient, which have proportionally higher costs, these institutions can actually often be considered as those which are serving very poor clients in rural areas and so on, just like very social NGOs and so on. And so by going out of the market, these are just going out with the smallest loans that they provide, and so the average loan size on the market can also increase. I think actually this is a way I try to explain my results with, but this is not something we looked at directly.
Tristan, I'm so sorry to interrupt. I think we've run out of time.
No problem. I'm
Possible,
happy to maybe to answer by message.
yes,
No problem.
if possible, you could either send your messages, send your answers over the chat box, or catch up offline.
Of course, thank you.
Yeah, and I would like to invite Misha for the next session.